In the first quarter of 2025, central banks purchased 290 metric tons of gold. That's 40% more than the same period in 2024. China added 103 tons. Turkey accumulated 45 tons. Russia continued its systematic accumulation despite sanctions. Poland, Singapore, and India all increased their gold reserves substantially. This isn't portfolio rebalancing. This isn't diversification. This is preparation. When central banks abandon the very system they helped create, when the institutions that print money start hoarding metal, when the guardians of fiat currency quietly build gold stockpiles, the mathematics become unavoidable. The system they represent is approaching terminal failure. Total central bank gold purchases since 2010 now exceed 4,500 tons. That's more gold than most countries possess in their entire national reserves. The purchasing pattern has accelerated dramatically since 2022. The same year global inflation reached multi-decade highs. The same year debt to GDP ratios in developed nations crossed critical thresholds. The same year confidence in currency stability began fracturing visibly. The frame. The pattern. Throughout recorded history, the collapse of monetary systems follows an identical sequence. First, the currency loses internal stability. Debt overwhelms productive capacity. Interest payments consume government revenue. The central authority faces an impossible choice between default and debasement. Second, foreign holders begin to diversify away from the failing currency. Not publicly, not dramatically, systematically. Central banks stop buying the dominant currency's bonds. They reduce their reserve holdings. They seek alternatives. Third, they turn to the asset that has never failed across 5,000 years of monetary experimentation. Gold, not because of tradition, not because of sentiment, because mathematics proves that when confidence in human promises breaks, only physical assets retain value. This pattern repeats with mechanical precision. The Roman transition from silver to worthless bronze, the Byzantine debasement from gold solidus to copper follis, the Spanish collapse from silver reals to debased maravedis, the French assignat hyperinflation, the German mark destruction, the British pound devaluation, every monetary collapse in recorded history preceded by the same sequence. Central authority debasement, foreign diversification, gold accumulation, system failure, no exceptions, no variations, mathematical certainty. This isn't a crisis. This is a phase. And every phase leads to the same conclusion. The historical machine. Rome, 235 to 284 AD. The crisis of the 3rd century. The denarius, once containing 83% silver, was debased to less than 5% silver content. Emperor Diocletian attempted to stabilize the system through price controls and monetary reform. But the damage was irreversible. What happened before the final collapse? The historical record shows systematic gold hoarding beginning in 260 AD, not by citizens, by provincial governors, by military commanders, by the wealthy merchant class. Archaeological evidence confirms gold coin hoards buried throughout the empire during this period. The people who understood the system were positioning before the general population realized what was coming. Gold to silver ratios during this period tell the complete story. In 250 AD, 1 gold aureus traded for approximately 25 silver denarii. By 280 AD, the ratio had collapsed to 4 to 1, not because gold became cheaper, but because silver content in denarii had been eliminated. Gold retained its value. Silver-based currency became worthless. Those who converted early preserved wealth through the transition. The Western Roman Empire fell within 2 centuries. Those who held gold survived the transition. Archaeological evidence shows gold-holding families maintained economic power through the Dark Ages. Silver-holding families disappeared from historical records. Britain, 1931. The gold standard abandoned. The pound devalued 30% overnight against gold, but the devaluation wasn't sudden. The warning signs existed 2 years prior. Foreign central bank behavior provided the signal. Bank for International Settlements records show that between 1929 and 1931, European central banks systematically converted pound sterling reserves to gold. The Banque de France alone converted 280 million to gold in 1930. The German Reichsbank converted $150 million. The Dutch central bank liquidated 90 million in sterling bonds. These weren't market panics. These were calculated institutional decisions. Central banks recognized that Britain's debt levels, trade deficits, and fiscal policies made pound devaluation inevitable. They positioned before public recognition. When devaluation occurred, their reserves were protected. Private British savers holding pound-denominated assets lost 30% of their purchasing power immediately. Those who had converted to gold maintained full purchasing power. The wealth transfer was instantaneous and permanent. Bretton Woods, 1971. President Nixon closes the gold window. The decision appears sudden to the public. The system breakdown was visible to central banks 3 years earlier. Federal Reserve gold outflows tell the complete story. U.S. gold reserves peaked at 20,663 tons in 1957. By 1970, reserves had fallen to 9,838 tons. Over 10,000 tons of gold transferred to foreign central banks in 13 years. France alone converted $3.4 billion to gold between 1965 and 1970. Germany converted $2.8 billion. Netherlands, Belgium, and Switzerland systematically extracted gold from the system. Charles de Gaulle's famous 1965 speech demanding gold convertibility wasn't economic theory. It was recognition that U.S. fiscal policy made dollar debasement inevitable. French central bank records show systematic conversion of dollar reserves to gold beginning in 1962, 3 years before the public speech, 9 years before Nixon's decision. Foreign central banks understood the mathematics. U.S. spending on Vietnam War and Great Society programs exceeded tax revenue by unprecedented amounts. The only solutions were fiscal restraint, massive tax increases, or currency debasement. Political incentives made restraint impossible. Tax increases were politically unfeasible. Debasement was inevitable. When Nixon closed the gold window, foreign central banks had already positioned. They held physical gold instead of paper promises. When the dollar lost 90% of its purchasing power against gold over the following decade, their reserves were protected. Translation to the present current global central bank gold purchases have reached levels not seen since 1967. The year before the Bretton Woods crisis accelerated. The World Gold Council reports that central banks added 1,037 tons in 2023, another 1,152 tons in 2024. Current trajectory suggests 2025 will exceed 1,200 tons. But official numbers understate the reality. Central banks are purchasing through multiple channels to avoid triggering price spikes or revealing the full scale of accumulation. China has increased official gold reserves by 78% since 2019. But official numbers are meaningless. Commodity analysts estimate China's actual gold reserves exceed 4,000 tons, possibly 6,000 tons. They're buying through commercial channels, avoiding public markets, accumulating systematically without triggering price spikes. Import data reveals the scale. China imported 1,343 tons of gold in 2023, another 1,089 tons in 2024. This gold isn't being re-exported. Shanghai Gold Exchange withdrawals, which represent gold leaving the exchange system permanently, totaled over 2,200 tons in 2024. This gold is being accumulated systematically by institutions that don't report holdings publicly. Russia now holds over 2,400 tons officially, but Western sanctions have forced Russian gold purchases through non-traditional channels. Mining production in Russia averages 330 tons annually. Domestic consumption accounts for approximately 60 tons. The remaining 270 tons is being accumulated by the central bank and state institutions. Russian gold reserves have likely increased by over 1,000 tons since 2022, most unreported in official statistics. Turkey has increased reserves by 383% since 2017. Poland's central bank added 130 tons in 2024 alone. Singapore's monetary authority accumulated 76 tons. India's Reserve Bank purchased 114 tons. Kazakhstan added 48 tons. These aren't commodity investments. These are monetary preparations. The pattern extends beyond direct central bank purchases. State-owned pension funds, sovereign wealth funds, and government-linked investment vehicles are systematically increasing gold allocations. The Norwegian government pension fund Global added gold mining equity positions worth $8.4 billion in 2024. The Kuwait Investment Authority increased precious metals allocations by 340%. The Saudi Public Investment Fund established a $12 billion metals and mining division. Meanwhile, these same institutions are reducing dollar reserve holdings. China has decreased U.S. Treasury holdings from $1.31 trillion in 2013 to $780 billion in 2025. Japan, traditionally the largest foreign holder, reduced positions by $180 billion since 2022. Total foreign holdings of U.S. debt have declined for 7 consecutive quarters. The pattern is identical to 1967-1971. Central banks are converting paper promises into physical metal, quietly, systematically, before the general public realizes the system is transitioning. Pressure without escape. The United States faces mathematical constraints that make this transition inevitable. Current national debt exceeds $38 trillion. Interest payments alone consume $1.1 trillion annually. That's 13% of total government revenue spent on debt service, not infrastructure, not defense, not social programs, just interest. The trajectory is unsustainable by basic arithmetic. Congressional Budget Office projections show debt reaching $54 trillion by 2034 under current policies. Interest payments will exceed $2.4 trillion annually. That's more than Social Security, Medicare, and defense spending combined. Just interest on borrowed money. Federal Reserve policy is trapped. Raise interest rates to fight inflation, debt service becomes impossible. Keep rates low, currency purchasing power erodes. Each percentage point increase in rates adds $380 billion in annual interest payments. The debt to GDP ratio has surpassed 130%. Every historical precedent shows this level is unsustainable, but the constraints go deeper than fiscal policy. The Federal Reserve's balance sheet expanded from $870 billion in 2008 to $9 trillion in 2022. Money supply increased by 40% in 2 years during COVID response. The velocity of money has collapsed as institutions hoard cash rather than lend. Traditional monetary policy transmission mechanisms have broken. Foreign central banks understand this mathematics. They can calculate debt service ratios. They can project fiscal trajectories. They can see that the system requires constant expansion of money supply to remain functional. And when money supply expands exponentially, gold becomes the only hedge against debasement. The gold market itself reflects this institutional demand. Annual global gold production averages 3,200 tons. Central bank purchases alone now consume over 35% of annual production. Add private investment demand, jewelry consumption, and industrial usage, and the supply deficit becomes obvious. Gold mine reserve replacement ratios have fallen below 50% for 5 consecutive years. New discoveries are at 30-year lows. Production costs have increased 340% since 2005. The physical supply cannot meet institutional demand at current prices. Price suppression through paper markets is becoming mathematically impossible. Gold lease rates in London money markets have turned negative repeatedly in 2025. This means institutions are paying to hold gold rather than lending it. This only happens when physical gold becomes more valuable than the income it could generate. This signals severe supply stress and urgent institutional demand. Shanghai Gold Exchange premiums to London spot prices have averaged 2.3% in 2025. Historically, this premium averages 0.2%. The persistent premium indicates strong physical demand in Asia that London paper markets cannot satisfy. Physical gold is becoming separated from paper gold pricing. The illusion layer, the common response to this data, is predictable. Gold doesn't yield income. Modern economies have moved beyond precious metals. Technology has made gold obsolete. Digital currencies provide better alternatives. The Federal Reserve can print unlimited money. This time is different. History provides the answer to each illusion. Every fiat currency in recorded history has eventually failed. The average lifespan of fiat currencies is 27 years. The dollar has existed as pure fiat since 1971. 54 years. Statistical probability suggests the system is in overtime. Every empire that debased its currency has collapsed. Every central bank that printed its way out of debt has destroyed the purchasing power of its currency. No exceptions across 3,000 years of monetary history. The belief that America is exempt from mathematical laws that governed Rome, Britain, Spain, France, and Germany is not analysis, it's faith. The Roman Empire had advanced technology for its time, concrete that lasted centuries, engineering marvels that still function today, global trade networks, advanced military technology. Technology didn't prevent monetary collapse. It couldn't overcome the mathematics of unsustainable debt. Spain controlled the most advanced naval technology of the 16th century. They possessed the world's largest gold and silver reserves. Global trade flowed through Spanish ports, advanced cartography and navigation. Technology didn't preserve Spanish monetary dominance. Fiscal excess overwhelmed technological advantages. Britain had the Industrial Revolution, steam power, railroad networks, global shipping dominance, the most advanced military and financial systems of the 19th century. London was the world's financial center. Technology didn't preserve the pound's reserve status. Mathematical forces were stronger than technological advantages. Digital currencies don't change the fundamental equation. Central bank digital currencies are simply electronic versions of the same fiat system. They can be created in unlimited quantities. They have no physical constraints. They solve none of the problems that make gold valuable during monetary transitions. The Federal Reserve's ability to print unlimited money is precisely the problem, not the solution. Unlimited money creation inevitably leads to currency debasement. The purchasing power erosion is mathematically certain. Central banks buying gold understand this. They're protecting against the inevitable consequence of unlimited money printing. The belief that this time is different is the most dangerous illusion. It prevents preparation. It maintains confidence in a system that mathematics proves cannot continue. It ensures that when the transition occurs, most wealth remains trapped in the failing currency. The final system statement. Central banks are not buying gold because they believe it will appreciate. They are buying gold because they know the current system is reaching mathematical limits. They are positioning for the transition that inevitably follows. The $1.2 trillion in gold purchases represents institutional recognition that the dollar-based system is in its final phase. When the institutions that manage the system begin accumulating alternatives to that system, the signal is unmistakable. This accumulation pattern has preceded every major monetary transition in recorded history. Roman governors accumulated gold before the denarius collapse. European central banks accumulated gold before Britain abandoned the gold standard. Foreign central banks extracted U.S. gold before Nixon closed the gold window. The current pattern is identical but larger in scale. More central banks, larger quantities, faster accumulation. The system being abandoned is global rather than regional. The consequences will be proportionally greater. The mathematical forces are already in motion. Debt exceeds productive capacity. Interest payments consume increasing shares of government revenue. Money supply expansion is required to maintain system function. Currency purchasing power erodes inevitably. Gold provides the only escape from currency debasement. Central banks understand this sequence. They are acting on this knowledge. The gold accumulation will continue until the system completes its transition. The timeline depends on confidence erosion and fiscal constraints. Both are accelerating. This is not speculation about what might happen. This is pattern recognition of what is happening. The same pattern that preceded every major monetary transition in recorded history. The same sequence that destroyed the Roman silver standard, ended the British pound's dominance, and terminated the Bretton Woods gold standard. The direction is absolute. The timeline is not certain, but the mathematical forces are irreversible. Central banks positioned for the transition understand this. They are accumulating gold systematically while the general public maintains faith in paper promises. The question is not whether the dollar-based system will change. The question is whether individuals will recognize the pattern and position themselves before the transition becomes obvious to everyone else. History shows that when monetary systems fail, those who hold gold survive. Those who trust in paper promises do not. The signal is clear. The institutions that created the current system are abandoning it. The mathematical forces that destroyed previous monetary systems are operating again. The pattern is repeating with mechanical precision. Only the scale is unprecedented.